In the world of trading, where every move on the charts can mean significant gains or losses, there are two essential tools that every trader must master: stop loss and take profit. These tools not only allow you to manage risks effectively, but also ensure that you trade strategically and without emotional interference. The stop loss, as the name suggests, is a mechanism designed to stop losses. Imagine you have an open trade, and the market begins to move against you. Without a stop loss, you could end up losing more money than you're willing to risk. With this tool, you set a predetermined limit for loss. When the price hits that limit, the trade is closed automatically, protecting your capital. For example, if you decide to risk a maximum of 2% of your account on a trade, you set the stop loss at a level that ensures that amount is your maximum loss, regardless of what happens in the market. On the other hand, the take profit is like your best friend in securing gains. When the market moves in your favor and hits your predefined profit target, this tool closes the trade automatically, locking in those gains before the market can reverse. For instance, if you're trading the EUR/USD pair and anticipate a 50 pip movement in your favor, you set your take profit at that level. Once the price reaches it, your trade closes with a profit. Now, why are these tools so important? Because they eliminate the need to constantly monitor your trades and, more importantly, help you avoid impulsive decisions. Without a stop loss, you might keep a losing trade open, hoping the market will recover, only to end up with much larger losses. And without a take profit, you could keep a winning trade open for too long, only to watch your profits vanish when the market turns against you. Setting your stop loss and take profit is not an arbitrary act. It requires analysis and planning. Your stop-loss level should be tight enough to limit losses, but not so close that it gets triggered by minor market fluctuations. Meanwhile, your take profit should be based on your trading goals and technical analysis, considering support, resistance, or relevant patterns on the charts. These tools are also fundamental to implementing an effective risk management strategy. A professional trader never risks more than they can afford to lose. This translates to risk-reward ratios, where the potential gain should always outweigh the risk taken. For example, if you're willing to risk $50 on a trade, your take profit should aim for at least $100 in gains, maintaining a 2.1 ratio. In summary, stop loss and take profit are the cornerstones of success in Forex. They're not just about limiting losses and securing gains. They're about trading with discipline, strategy, and confidence. Using these tools is not optional. It's essential for any trader striving to be consistent in this dynamic market. So, the next time you open a trade, remember to set your stop loss and take profit. You're not just protecting your account. You're paving the way for safer and more successful trading.